T-bills, CDs, and money markets are paying around 5% interest. But don't you hate micromanaging your cash balance, shuffling around from checking to T-bills, T-bills to checking, and so on? It's a major headache. What if we could get comparable return, but didn't have to deal with the hassle of building a T-bill ladder, auctions, planning how much cash is needed by a certain date, and so on? What if we just put money in, pay bills with ACH, checks, or debit cards directly from the account, and get nearly the same return as T-bills? It sounds too good to be true, but Fidelity's cash management account can provide this while delivering about 4.2% interest. Even better, they currently offer a $100 bonus for opening an account. I recently switched to use this as my primary banking setup, and I think it's great. In this video, I'll explain to you how this account works, how risky it is, and how it could actually provide a higher return than using a combination of a traditional checking account and T-bills. Hi everyone, I'm Nick. Welcome back. If you're new to my channel, my goal is to provide you with high value, no nonsense content to help you learn what you need to know to achieve financial independence. If you get value from this content, make sure to like the video and subscribe. The Cash Management Account, or CMA, is a special brokerage account with Fidelity that can function similarly to a checking account. Here are some of the key features. It has no account fees. It has FDIC insurance on cash balances. It's currently offering 2.34% interest on these FDIC insured balances. I know I said over 4% earlier, and we'll get to that in a minute. It has a debit card with ATM fees reimbursed globally. Bill pay, checks, ACH, direct deposit, mobile check deposit are all available. Free checks are even available. You get a routing number and an account number like a traditional bank account. And you can even invest in this account if you choose. Getting some of these features at traditional banks often requires private banking. Let's talk a little more about FDIC insurance. With all Fidelity brokerage accounts, you have what's called a core position or a sweep. When you have uninvested cash, this is how that cash is held in a traditional brokerage account. It's typically in a money market, which is not FDIC insured, but often holds very safe investments like T-bills or similar. In the cash management account, Fidelity has partnered with various FDIC insured banks, and they will sweep your cash balance to those banks. This actually allows them to offer you more than the standard $250,000 of FDIC insurance in just one account because they split your balance across multiple FDIC insured banks. You can get separate FDIC coverage from each bank. In this way, it's possible to get over $1 million of combined FDIC coverage through this account. They currently list 26 banks with which they are partnered, including many well-known banks. I'm just providing a brief summary. You should definitely read the disclosure document from Fidelity to learn more, linked below. All right, so how do we get over 4% interest? We can do this by using Fidelity money market funds. But how does that work if the default core position is the FDIC option, and how safe is it? Well, the way it works is really cool, and it's about as safe as T-bills. Let me walk you through it. With the cash management account, if your cash sweep balance is $0, Fidelity will automatically liquidate money market funds to cover the transaction. This could be when you withdraw money at an ATM, have an ACH to pay a mortgage or a credit card. This only works with Fidelity money market funds, not ETFs, mutual funds, or stocks. This means that you can effectively withdraw cash or pay bills directly from the money market funds. Fidelity has several money market funds available, many yielding over 4% currently. I'll briefly discuss my favorite, but comparing all the options warrants a separate video to cover in detail. If you're interested in this comparison, let me know in the comments. Also, if you haven't done so, make sure to subscribe and like the video to support free financial education. It helps me provide the free content. I prefer using FDLXX, which invests in only short-term US Treasuries like T-bills. and currently has a 36-day average maturity and is yielding over 4%, 4.16% as of February 28th. If you look at the composition of the fund, it has 87% in T-bills, 7% in Treasury coupons, and 6% in other, which is likely cash. The maturity distribution is 15% in 7 days or less, 41% in 8 to 30 days, 17.5% in 31 to 50 days, 23.75% in 61 to 90 days, and just under 3% in 91 to 180 days. This fund is basically laddering the T-bills for you, saving you the headache. Unfortunately, this comes with an expense ratio of 0.42%, which means they take this fee from the returns. The 4.16% return listed is after this fee. Laddering T-bills yourself is certainly cheaper, but I think the convenience of this option, the auto liquidation it provides, outweighs the costs. Plus, you don't have to wait for it to mature to access the money. While this fund is not FDIC insured, it holds only US Treasuries. It is possible for money market accounts to freeze withdrawals for some time or even to lose money in money market accounts. But I think the likelihood in a short-term Treasury-only money market fund is so low that I am very comfortable with it. Also, I think Fidelity is a very well-run institution. Unlike banks that take your cash and loan it out, Fidelity is simply managing this fund for you. If you look at the fund's statement of additional information, you can see that the custodian that actually holds the assets of FDLXX is Citibank. Even if something happens with Fidelity or Citibank, these treasury securities and the money market fund should be segregated and belong to you. Now, I like having layers of defense in anything I do, so this isn't my only banking option, it is my primary one though. If withdrawals were frozen, I have other options to fall back on. Note that this treasury-only fund cannot be set as the default core position, but the CMA account has a tool that can auto-invest into this fund so you don't have to do it manually. The options you can use as the core position are still quite good, but I would need another video to cover them in more detail. My only gripe with this setup is really the 0.42% fee. Vanguard's money market is certainly better since it has a lower fee, but the convenience of using this Fidelity one as an all-in-one banking solution is worth it to me. I'd rather save the hassle of moving money back and forth between accounts, making sure I have enough to pay my bills, and so on, and just pay this fee and be done with it. Now, you can use the CMA account on its own in the way I just described, but you can also get a couple extra features by pairing it with a regular Fidelity brokerage account. You can use the brokerage account for overdraft protection on the CMA. So if your CMA cash sweep balance and money market balance are both zero, instead of the transaction failing, Fidelity can use your brokerage account as overdraft protection and withdraw from there. It can do this from the brokerage sweep core position, which is a money market account, or other money market accounts in that brokerage account. If you have margin enabled on your brokerage account, it can even fund overdraft protection with margin, although that's quite risky. Similar to the CMA, they will not liquidate mutual funds, ETFs, or stocks, just money markets. They will first try to take from your CMA's FDI sweep, then your CMA money market fund. If those are both zero and you have overdraft protection enabled, it will then use brokerage sweep or money market account in your brokerage account. And even if you want another layer, it could use margin if you have that enabled. Another reason for considering this setup is you can leave your CMA account balance at zero and just have the default core position in your brokerage account handle transactions. Instead of having to convert to and from the FDIC swap and money markets in the CMA account, you can just direct deposit cash right to the brokerage account, which will go into the brokerage default core position, which could be one of their money market funds. Now, if you don't want to do this and just keep it a little simpler with the CMA does have features to auto-invest and liquidate cash to and from certain investments. So you could use this to maintain a minimum cash balance in the FDIC insured sweep account, and then have it auto-invest or liquidate from the money market fund to that if you want to maintain a certain amount of FDIC coverage. So why do I think this fund can provide higher returns than a traditional setup? Well, let's look at an example. Say you have a checking account in an emergency fund that contains 6 months of expenses at $5,000 per month. This is $30,000. If you use a traditional checking account, they are paying almost 0% in interest, but you would need to keep some cash there for paying your bills. Let's say you keep 1 month of expenses in this checking account and then put the rest in a T-bill ladder. In 1 year, your cash balance of $5,000 might earn you $3 in interest. Your $25,000 in T-bill might earn 4.75% at current rates, which is about $1,187.50. This is a total return of $1,190.50. It still doesn't match inflation and will be taxed, but it's not horrible. Now with the Fidelity setup, if you're comfortable with it, you could potentially put all $30,000 in the money market fund. You don't need to shuffle in and out of T-bills or do another account. You just pay directly from this account and the money market is liquidated automatically. If you do this with the $30,000 and get the current 4.16% interest, that would yield $1,248, which is both simpler and higher than the other setup. Now, if you want to be a little more conservative, you could keep 1 month of expenses in the FDIC insured sweep account. This is currently yielding 2.34%. The total return of this example, with $5,000 in the FDIC sweep and $25,000 in the Treasury-only money market, would be $1,157 in interest for the year. This is a little lower than the traditional bank and T-bill option, but only by $33.50. And that's before tax. After tax, it might be $20 or $25. I would happily give up $25 to have the simplicity of this option and not have to deal with the headache of planning how much cash I have available in my checking account. What are some of the concerns and issues with this setup? First, this isn't a traditional banking setup. If you use the money markets, they are not FDIC insured, but there are some really solid money markets available, like the Treasury-only money market fund. Second, it requires Fidelity systems to work correctly to automatically liquidate your funds. I don't see this as a big risk, and these types of failures are possible with any company or software system, including a traditional bank. Third, Fidelity partners with banks to provide the FDIC sweep and some features like bill pay. This means things like bill pay could be a little clunky. One of my friends had an issue with their bill pay service, but a lot of people post positive experiences. I don't use the bill pay myself, so I can't comment on that. Finally, if you commingle your investment portfolio in your CMA or the brokerage used for overdraft protection in the CMA, it's possible that your investment portfolio could somehow get liquidated, or if someone got access to your account, they could liquidate the investments. For this reason, I have a dedicated CMA and brokerage account specifically for this setup. I do not commingle my investment portfolio with this banking setup. Now, I don't get anything for mentioning this, but Fidelity is offering a $100 bonus currently if you open a new CMA or brokerage account and deposit at least $50 within 15 days. Based on my understanding, you can only get this for one account and you aren't eligible if you've received a similar reward previously. Again, I don't receive anything for mentioning it, and this offer could expire, but it is currently available. What do you think about this banking option? Let me know in the comments below. If you got value from this video, make sure to hit the like button and subscribe. Thanks everyone, later.